Welcome everyone to this webinar. My name is Habib Akiki. I am the Director of Research and Market Education with Daman Markets. We are all sad about what is currently happening in this region, and I hope you and your loved ones are safe. I am Habib Akiki, Director of Research and Market Education. I have over 16 years of experience trading and working in the financial markets. I have a bachelor's degree in banking and finance, a master's degree in financial management, and I'm also a certified financial technician, certified technical analyst from the International Federation of Technical Analysts. I'll be your host for this webinar. And in this session, basically, we will look at how geopolitical risk and conflicts can transmit into markets and affect pricing across major asset classes. We will focus on gold, oil, and stocks. This is an educational session where we will focus on market mechanics, historical behavior, and risk awareness. All that we will cover should not be considered as investment advice or trade recommendations. We will start with the core drivers of gold, then review historical patterns during geopolitical stress. Gold went up 2.6% since the start or since the beginning of the war, but after 2 days, it dropped to levels around, it dropped by 5.7% to levels before its pre-war closing. And today, still, it remains 2.5% lower than where it was on Friday, 27th of Feb. Now, despite being thought of as the major safe haven asset in such times, gold did not behave or did not perform as expected. We will explore the reasons why. After gold, we will move on to oil and connect the Strait of Hormuz to energy pricing, inflation expectations, and potential monetary policy reactions. Now, oil went up 77% and is still 30% higher than its pre-war closing price. And earlier this week, it surged and then reversed sharply, moving as much as 30% in both directions within the same trading session. This is how sensitive oil is to geopolitical conflicts. So no trader should be trading oil without clearly understanding what are the key drivers. After covering gold and oil, I will take you through equities. We will shift to equities, including which sectors historically tend to hold up better and how the S&P 500 behaved and recovered in times of geopolitical shocks. Now, guys, at the end of this webinar, we will have around 15 minutes for Q&A. But again, I like my sessions to be as interactive as possible. So along the way, if you have any questions, please do not hesitate to drop your questions in the questions window. And I will make sure to answer them whenever I can. Let's start with geopolitical shocks. Now, geopolitical shocks typically work through few channels. It starts with risk premium rising as uncertainty increases. We will have a lot of examples on this. Energy markets can reprice quickly if supply chains and routes are threatened. Then, currencies and bond yields can shift as inflation and policy expectations change. If the war will lead to higher inflation, central banks will lean towards raising interest rates. And if war will lead to economic slowdown, then central banks will lean towards lowering rates to support economic growth. And finally, investors may reduce risk across portfolios, which can create cross-asset flows and liquidity-driven selling. This is how geopolitics or geopolitical conflicts transmit directly through different asset classes. we could see safe havens benefiting. Oil, which is sensitive to these conflicts, could also benefit. While when we move on to equities, this is where things basically we should separate each sector, and this is where stock picking makes more sense to investors and basically will result in good profits or benefit them the way it should. So stock picking in such times is very important. We will talk about the sectors that will benefit. We will talk about the sectors that will be affected in a bad way. And we will basically clear out all your questions about why gold didn't perform well. Could oil keep going up? Or after this sharp reversal that we saw a couple of days ago, this is the high. This is the high that we will see for the coming period. Let's start with gold by taking a look at the various factors that affect gold prices. Now, I'm sure you trade gold. I'm sure you know about gold. I want to ask you, what are the factors that affect gold prices? And here I'm talking regularly, not during conflicts, but rather in general. What are the factors that affect gold prices? As is the case with any financial asset or tradable commodity, the demand and supply for gold plays a crucial role in determining its price. Like any other tradable commodity, demand and supply is a very important factor. Now, when it comes to gold, yes, Jivan, as well, this is something that will definitely affect the price of gold, which is the demand on jewelry in festive seasons. So when we talk about demand and supply, the main reason behind the continuous rise in gold prices is that global demand for gold is 1,000 tons per year more than the supply. So the demand for gold is 1,000 tons more than the supply. Annual gold demand in recent years has averaged around 4,500 to 4,800 tons, while mine supply is roughly 3,500 to 3,700 tons, meaning the physical market is structurally tight. Now, if we look at the prices of gold, and here I'm displaying a chart from the 1999, so early 2000s. And we can see here gold prices were around $250, and now gold is trading above $5,150, when $5,170. Of course, nothing goes up in a straight line, but if we look at the long-term trend, it's always in an uptrend. And this is basically because there is more demand than the supply available for gold. Now, for gold, we have demand for jewelry, like Jivan stated. The manufacturing demand is also there. So for gold, we have the demand for jewelry. The manufacturing demand is there since gold is used in the manufacturing of certain electronic and medical devices. And we have the investment demand. Investment funds acquire gold and offer investors tradable shares. So when you go and buy an ETF or an exchange traded fund that to benefit from gold, which is called a gold ETF, what happens is that this fund will acquire gold and then issue investors tradable shares. So demand of gold comes from physical demand for jewelry and savings. It comes from manufacturing demand, and it comes from investment demand. Now, in recent years, gold purchases from various investment vehicles was around 1,300 ton per year, representing around 30% of the total gold demand. And let us not forget the demand from central banks as they continue to diversify their monetary reserves away from paper money into gold. Central banks have been record buyers, purchasing over 1,000 tons per year since 2022, the highest level in more than 50 years. All these factors show that demand is structurally strong and supported by real flows. Now, another major factor that notably impacts gold prices is inflation. So inflation is another factor that impacts gold prices. Gold is often viewed as an inflation hedge because when purchasing power declines, investors seek assets that hold their value. Now, one thing to note here, though, is that markets are forward-looking and prices tend to react to expectations. Therefore, gold is more correlated with inflation expectations as compared to inflation itself. So we all know that inflation is the increase in the cost of goods and services. Now, when inflation increases, what happens to our purchasing power? It decreases. To preserve this purchasing power, investors tend to invest in assets that also their value increases alongside inflation. Safe assets. And gold is one of these assets. One thing you should be aware of, that markets are forward looking. So if I expect inflation to go up, now I go and buy gold. I do not wait for inflation to go up and then I go and buy gold, because it would be too late. Right? So, yes, gold is a good hedge for long-term inflation. But on the short term, the correlation with inflation is very low. It's below 0.3%. So gold is more correlated with inflation expectations. Again, if I expect inflation to go up in the future, in the coming month, traders will go now and rush to buy gold now. Because if they wait, other traders would have bought before them, and this will cause the price to rise. So they will miss the boat. Also, interest rate and government bond yields is another factor affecting gold prices. There is a negative relationship between gold and interest rates. When rates rise, investors flock to fixed income investments that yield a fixed return, unlike gold, which does not provide any return to its holder. Now, if I buy gold, how do I benefit? I do not get any return. The only way to benefit from gold is to hold it and then sell it at a higher price. But meanwhile, while I'm holding, I'm not receiving any interest. While if I invest in government bonds, which are like gold, tend to hold their value, they also provide interest. So when interest rates rise, the opportunity cost of holding gold also rises, and this puts pressure on gold prices. Gold prices, something to note here, gold prices are more sensitive to changes in real interest rates. Okay? So we have nominal interest rates and we have real interest rates. Nominal interest rate is interest rate before taking inflation into account. Real interest rates is the rate adjusted for inflation. So real interest rate is interest rate minus inflation. This is the real interest rate. So if today interest rates, if the interest rate today is 3% and inflation is around 2%, what is the real interest rate? Only 1%. Interest rates are 3%, inflation 2%. So basically, what is the interest effectively? It's only 1%. 3 minus 2% inflation, the result is 1. And there is a very, very, very strong inverse relationship between gold prices and real interest rate. This correlation stands at minus 0.82. Minus 0.82. So every time real interest rates go down by 1%, gold goes up by 0.82%, and vice versa. Okay? So every time real interest rates go up by 1%, gold goes down by 0.82%. And this is a very, very strong inverse correlation. And in my opinion, this factor, which is a combination of two factors, it's a combination of inflation and interest rates. This is the factor that affects gold prices the most. So if you really want to know what will happen with gold prices in the future, you must look into inflation and interest rates. What other value affect gold prices? The dollar. The value of the dollar, of the US dollar, is another strong influencer. Guys, gold is priced in US dollars globally. Okay, so it's denominated in US dollars. So when the dollar strengthens, gold becomes more expensive in for non-US buyers in foreign currencies other than the dollar. If the dollar goes up, I will need more euros to buy the same amount of gold. So as the dollar value goes up, this will reduce the global demand for gold because it becomes more expensive in other currencies. So in a simple summary line, dollar goes up, gold becomes more expensive globally, demand softens, price drops, and vice versa. And of course, the fifth factor is the talk of the hour, economic risks and geopolitical factors. Now, during periods of geopolitical stress or financial instability, investors often shift towards perceived safe haven assets such as gold. So in the financial markets, we have a lot of safe haven assets. We have bonds, government bonds, US government bonds, which are considered very safe assets. We have gold because it's a precious metal, it's a store of value. And we also have the US dollar because it's the currency of the strongest country in the world and the biggest economy in the world. We have also the Japanese yen and we have the Swiss franc. These are considered the safe havens: gold, bonds, yen, dollar, and Swiss franc. Now, in early 2022, following the Russian-Ukrainian conflict, gold surged above $2,050 per ounce amid heightened geopolitical risks and has more than doubled since. So just 3 years ago, gold was at 2,000 per ounce, $2,000 per ounce, and now it is 150% higher, trading above 5,150. So imagine that's an average of 50% increase in the last 3.5 years. Almost around 50% increase per year. You could have earned 50%. Whoever invested in gold 3 years ago and is still holding, he more than doubled his money. And I'm talking without using leverage. With leverage, it depends how much leverage he's using. Now, no single factor determines gold prices. It is the interaction between inflation expectations, yields and interest rates, the dollar strength, the risk sentiment, and ultimately, this is what drives price movements. the interaction between all these five factors that we listed just now. Now, gold during wars. Look at this chart and tell me, what do you notice? In gray, we have the global economic uncertainty, and in yellow, we have the gold price. Do you notice any correlation, positive, negative? In general, if we look at this chart, we can clearly notice that there is a positive correlation, right? Most of the time, as uncertainty increases, gold prices also increase. Now, of course, I can look at this chart and I can point out to several occasions where we didn't see this inverse correlation. This positive correlation, right? For example, here in 2008, you can see how global economic uncertainty rose sharply. But what happened to gold prices? They dropped before rallying higher. Now, I will talk about this in details, but in general, there is a positive correlation between uncertainty and gold prices. As uncertainty levels go up, so does gold prices. During geopolitical tensions and times of uncertainty, gold frequently attracts safe haven and hedging demand. But the reaction is not automatic. A lot of clients asked me, wondering lately in the last few days since the beginning of the war, I've received a lot of questions from clients why gold didn't shoot up as expected. A matter of fact, why is gold down more than 2% today since the beginning of the war while it should be going up? Well, sometimes the market reaction is different from what the mass expects. And that happens for several reasons. One of these reasons is if the event itself is widely anticipated, some of the move may already be priced in. Again, as I told you, markets are forward looking. Yeah, markets are forward looking. So market reacts to expectations, not to the real event. And here, let me elaborate a little bit. The US military positioning started weeks before the strikes. We all remember that since the beginning or since mid-February, the market was observing aircraft carriers, naval groups, and missile defense systems moving into the region. So what happened is that markets and investors and traders began to price the probability of escalation. And we saw gold prices going up since mid-February. Gold prices started to go up. Remember, markets move on expectations, not on the event itself. And here, I will refer back to the chart. Jivan is asking, what was the impact during Corona time? Is there any impact of pandemic situation? Yes, and I have a separate slide just to highlight the impact that we saw on gold due to Corona in March 2020. So this is one of the main reasons why gold did not behave the way it should or the way that most market participants were expecting, because the move was already priced in. Okay, so a lot of people saw the US moving vessels here, and it was the biggest military crowding since I think the 2003 war. So yeah, we all had this possibility, especially that also the talks, the negotiations between US Iran was not going well. Now, also another reason that if the dollar and the yields rise sharply, they can pressure gold even when risk aversion is elevated. So remember, from the factors that affect gold prices, we mentioned interest rates and we mentioned the US dollar. And of course, geopolitical instability or uncertainty. So these three factors are 3 out of 5 factors affecting gold. So here we are talking about 3 factors. We have geopolitical conflicts. This should push gold up. But at the same time, what happened? We saw gold going down because the US dollar was going up and because interest rate expectations was also pointing towards an increase in interest rates. Why? Because oil prices moved sharply higher. So again, part of the safe haven demand for gold had already been priced in, correct? However, the asset that reacted most sharply to the escalation was oil. The conflict directly threatened energy supply routes in the Middle East, pushing oil prices sharply higher. Oil went up to 77% from 60s to the 120. It barely touched the 120 dollar per barrel. So imagine 77% increase in a matter of 1 week. What are the effect of this sharp increase in oil prices? Rising oil prices increased inflation expectation. Oil is a leading indicator of inflation. When energy prices go up, production prices go up, transportation prices go up, shipping prices go up, shipping prices goes up. Everything goes up, and this will lead to price inflation. Higher inflation expectations pushed yields and rate expectations up. This is what strengthened the US dollar. So higher yields together with a stronger dollar increased the pressure on gold prices. So gold now is fighting these 3 factors. We have geopolitical uncertainty, safe haven demand. This will push the gold price up. But at the same time, we have a stronger dollar pushing gold down. And we have the interest rate. Remember, there is an inverse correlation between interest rates and gold that is minus 0.83. So this is the main reason why gold did not go up in the last 10 days. The key message here is that, yes, gold reacts to geopolitics through risk sentiment, but it also responds to rates and currency dynamics. Is oil the new gold in present situation? I will answer your questions shortly when I basically state the factors that are affecting oil prices and when we look if these factors will continue to affect oil prices the way. And by the way, I'm not saying that gold will not play its role as a safe haven. And I will reach this conclusion shortly. Actually, there is another important reason why safe haven does not always mean a one-way price action. So sometimes we see gold falling in times of crises. Now, During acute liquidity events, investors may face margin calls and portfolio losses across multiple assets. In such situations, profit taking and forced selling can occur, and investors often sell what they can, not what they want to sell. Look at this chart. So on this chart, we can see in blue, the blue candles are the gold price, and the yellow line is the Nasdaq. Okay, the Nasdaq, the US 100. It is the technology index, representing 100 of the technology stocks in the US market. Notice here what happened. So this move up was the move that started since mid-February, when the US started moving their carriers here. Gold started to go up. We are seeing this sharp upward momentum in prices, and the market closed here before on February 27th, Friday, February 27th. The market closed here at this level. So as you can see, the geopolitical risks were already priced in. Gold started to move up before the actual strike. This weekend here on February 28th is where the first strike happened, where the US striked Iran. Of course, Monday we saw this gap higher. Gold opened here, maybe 1.5%, 2% higher. It moved a little bit up, but then on the next day, on Tuesday, March 3rd, what happened? Gold dropped more than 7%. The war is escalating and gold is dropping. Why is it dropping? Okay, the dollar is going up, oil is going up, inflation expectations are going up, interest rate expectations are pointing towards higher interest rates. All these factors are affecting gold, putting some pressure on gold, but the main reason was liquidation. Traders started to feel the pain. It was a big drop in stocks. The Nasdaq dropped on Tuesday, March 3rd, dropped in one day 2.5%. And look how this drop came alongside the drop in gold. Actually, the drop in gold came alongside the drop in equities. Remember, up to this point, the stock market was contained. So on Monday, when the first trading day before the actual hit on Iran, the US stock market did not drop, was not affected negatively. Basically, it was holding well, especially technology companies. What happened on Tuesday? The stock market started to feel the heat. And as the stock market dropped, a lot of portfolios got margin calls. So investors wanted to support their portfolios. How? By cash. So again, during acute liquidity events, investors may face margin calls and portfolio losses. In such situations, investors are forced to take profit and sell the investments that are profitable to cover the losses on other investments. So to cover the losses on stocks, investors were selling the assets where they have profit. And this happened especially because gold has been going up for the last 3 years. So most investors own gold in their portfolios. And because gold is very liquid, we saw that a lot of investors were rushing to sell profitable positions to cover losing positions. On March 3rd, as the Nasdaq dropped by 2.5%, gold dropped 7%. Because gold is highly liquid and widely held, it is often used as source of liquidity or collateral to meet margin requirements, especially that it has been going up massively since 2022. We are talking about 150% increase or appreciation since 2022. The World Gold Council has highlighted how sharp market sell-offs can trigger margin calls, forcing investors to raise cash by liquidating liquid assets such as gold. And here we will look into other historical performances. This, what I explained in the previous slide, is something known as the dash for cash. Dash for cash. There is a historical precedent for these types of pullbacks in gold. The correlation between gold and stocks is generally negative. So when generally, yeah, I'm talking generally. So when stocks go down, usually gold goes up because it is a defensive asset. So when when the stock market is not performing well, usually traders tend to go and park their investments in gold. This is not the case every time. There seems to be an exception during periods of disorderly selling when volatility spikes to extreme levels. And here, Jivan, you asked about the corona, yeah, the COVID, and this is the March 2020. This chart also displays the gold in blue and white, and in yellow the Nasdaq 100. And look here what happened in March 2020 when the COVID pandemic triggered one of the fastest market crashes in history. Gold behaved in a way that surprised many investors. Even though gold is considered a safe haven, it initially fell sharply before later rallying strongly. This is consistent with a dash for cash dynamic. Now, the dash for cash dynamic takes three phases. In phase one, what happens is market panic. So between February 19 and March 23 of 2020, global markets experienced extreme stress. The S&P 500 fell about 34% in just over a month. So in around 1 month, the S&P 500 dropped 34%. Credit markets tightened rapidly. Volatility surged to levels last seen during the 2008 financial crisis. Basically, investors across the world rushed to raise cash and liquidity. Investors didn't want any investments. We thought the world is going to end. We don't want stocks, we don't want bonds, we don't want gold even. We want cash. This is the dash for cash. This is the phase two of this phenomenon. During the worst day of the pandemic, investors faced margin calls due to falling stock prices. Hedge funds and institutions needed US dollar liquidity. Many investors sold liquid assets, even safe ones. Gold was one of the most liquid assets available, so it became a source of cash. As a result, gold dropped from around $1,680 per ounce on March 9 to about $1,470 on March 19. That decline was roughly around 12% from peak to the sell-off. Now, this was not a loss of confidence in gold. right? This was rather a forced liquidation. And now comes phase three, the policy response from central banks. Here, central banks stepped in, they intervened aggressively. The Federal Reserve launched the unlimited quantitative easing program, massive liquidity injections in the market, interest rates collapsed, real yields, real interest rates fell sharply, and gold quickly regained its safe haven role. By August 2020, okay, less than 6 months after the 12% drop, gold surged to a record high near $2,072 per ounce, rising roughly 40% from the March lows. Again, here, Jivan, what can you, not only Jivan, again, here, guys, what can we conclude? That despite this abnormal behavior of gold, it usually tends to go back and regain its safe haven characteristic. It regains the safe haven feature and tends to rally after the drop. So when uncertainty hits, when we have liquidity constraints, investors tend to sell what they can. They sell profitable positions, they sell liquid assets, gold, to raise cash. But then the moment things settle a little bit, they go and buy again gold. And this is when the safe haven kicks in, the safe haven demands really kicks in, and we see gold going up. So again, this is something that could happen if the escalation continues in the future. So if the current war didn't cool down sometime soon, we could see the safe haven demand kicking in and gold prices going up. That's why it's very important to monitor the situation, to monitor these factors that we talked about. It is very important to monitor oil prices, because what's driving the market now is not gold, is not stocks. What driving the market now are expectations of inflation and interest rates. And these are the two main factors that every investor should be focused on. Gold can fall during acute liquidity crisis because investors sell liquid assets to raise cash. But once liquidity stabilizes, gold often rebounds strongly as a safe haven. And look here, what happened in March 2020? Gold dropped, but what happened few weeks later? Just in 1 month, 1.5 months, and then it went up. It went up from 1,460 to over $2,070. And this also happened again in the global financial crisis in 2008. During the global financial crisis, gold also experienced pullbacks early on. The World Gold Council noting declines in the range of 15 to 25% at points in 2008, even though gold ended that year as one of the few assets to post positive returns. So in 2008, during the financial crisis, gold dropped 25%, but then moved up again and ended the year with profits. Now let's talk about oil. So what are the factors affecting oil? First, we have the physical supply and spare capacity. Oil prices are strongly influenced by actual production levels and availability of spare capacity from major producers. OPEC, for example, can increase or reduce supply to stabilize the market, and they have been doing so for years now. Second, we have the demand outlook and growth expectations. Global economic growth expectations shape oil demand as stronger industrial activity, transportation, and consumption increase energy demand and support higher prices. We have also inventory levels and disruptions. Oil inventories act as a buffer for the market. Falling stockpiles and unexpected supply disruption can tighten supply and push prices higher. We should also consider shipping routes and checkpoints. Key maritime routes, such as the Strait of Hormuz, are critical for global oil trade. Any disruption to these choke points can create supply concerns and increase volatility in energy markets. And last but not least, we have geopolitical risk premiums. So when geopolitical tensions rise, markets often add a risk premium to oil prices to reflect the possibility of supply disruptions or instability in major producing regions. And what did this recent conflict affect? It affected production, it affected inventory levels, and it affected shipping routes. All because of the Strait of Hormuz. Now, the Strait of Hormuz is one of the most strategically important energy corridors. It is a very critical global energy choke point. As you can see here, it's this narrow corridor, okay, between Iran and the Gulf. The Energy Information Administration, the EIA, estimates that in 2024 and 2025, oil flow through the strait from these countries here through this strait averaged about 20 million barrels per day. Now, this oil comes from 7 countries located in the Persian Gulf. These countries are the UAE, Qatar, Bahrain, Saudi, Kuwait, Iraq, and Iran. For major oil producers in the Gulf, this is the primary route to global markets. So all the oil that is produced from these countries here, most of it goes out to the global markets through this strait here. So this strait, tight, 33 kilometers wide at its narrowest point, is responsible for basically sending oil to the global markets. This is roughly equivalent to about 20% of global petroleum liquids consumption. So 20% of the global consumption passes through this choke point. The EIA also estimates that 84% of the crude and condensate moving through Hormuz most of the 84% of the crude passing through Hormuz goes to Asian markets, with China, India, Japan, and South Korea as top destinations. The strait closure is taking center stage. The strait's shutdown has pushed Brent crude from $60 to nearly $120. Why? Because if Hormuz, I will explain why in 4 short points, because we are running out of time. Now, if Hormuz remain blocked, even partially, oil prices can spike further, and that doesn't just hit fuel. Beyond crude itself, shipping, insurance, and rerouting can raise freight costs, which feeds into production costs across supply chains. So that can also add inflation pressure, meaning higher prices for everyday consumer, which then feeds into interest rate expectations and the monetary policy path of central banks. And this is what happened and drove the dollar higher. The closure of Hormuz basically caused not only higher oil prices, higher insurance costs, higher shipping, higher freight costs, higher production costs, and then higher inflation. And higher inflation led central banks to start considering increasing interest rates. So if the closure remains for days, weeks, or even months, this is catastrophic, not only for the region, not only for Asia, but for the global economies. So this is the strait again, and you can see all these blue lines, this like the blue waves. This is basically the vessel's traffic. And you can see it's coming from the GCC countries, the oil producers, through the Strait of Hormuz, and it goes to Asia. Now, for countries, the biggest impact would land on major importers. Major importers are China, India, Japan, South Korea. These account for a combined 69% of the Hormuz crude and condensates flow. Now, Japan is the most exposed, importing over 90% of its crude from the Middle East. So Japan imports 90% of its oil consumption from the Middle East. Imagine what will happen to the prices in Japan. If Japan cannot import anymore from the Middle East, it will go and start searching for other alternatives at a higher cost, of course. India. Reuters reported that approximately 40% of Indian crude comes through the Strait of Hormuz. And China, the largest oil importer, Reuters reported that China sources about half of its crude from the Middle East. Now, imagine an increase in Chinese oil costs. What will this do? It will eventually ripple well beyond its borders and into the global economy. If oil prices increase in China, production prices will increase, transportation prices will increase, shipping prices will increase, everything we buy from China will increase in price. So this is global inflation. That's why the Strait of Hormuz remain one of the most strategically important corridors in global trade. Disruptions here doesn't just move markets. It can reshape entire industries and economies worldwide. By understanding its pivotal role, we gain insight into forces behind global price swings. Moving on to equities. Now, when it comes to oil, the question remains, how long will the strait closure continue? The more it continues, I think the more pressure will be on oil prices. Moving to equities. Now, stocks often react with an initial sell-off and higher volatility. Of course, when we are talking about a war, geopolitical risks, what will happen to the stock market? The natural or the first and the natural reaction is an initial sell-off and increased price volatility. Then the path depends on whether the event triggers recession risk or inflation shock. This is very important because an increase in the price of oil, for example, have two effects. It can increase inflation expectations, and it can also affect growth negatively. And it can do both at the same time if it lasted for a long period. Now, if energy prices surge, margins can be squeezed and consumer demand can soften, which matters for earnings. So companies' earnings will also drop. Sales will drop. Earnings will drop. Stock prices will drop. Historically, markets have often recovered after geopolitical shocks, but the speed varies by episode. And in this current case, by whether oil becomes a sustained macro problem. Now, despite these challenging conditions, the stock market continues to offer opportunities. While some sectors and companies may suffer during geopolitical tensions, others can emerge as beneficiaries. Now, in periods of geopolitical tensions, relative performance often becomes sector driven. And here are the sectors that could benefit. Energy stocks and defense can benefit when risks rise and demand expectations shift. Energy companies benefit more when they sell oil at a higher price. And that is one reason why the local and regional stock markets witnessed a contained blow. Markets here in the region, whether locally in the UAE or in the neighboring countries, basically witnessed a contained blow, very contained blow. Markets were not affected as bad as some expected. Why? Because definitely the energy sector helped. Energy companies benefit from higher oil prices. Now, war often leads to higher government defense spending, which benefits military and defense contractors. Companies that historically benefit from increased defense spending include Lockheed Martin and Raytheon Technologies. Raytheon Technologies is the company that provides the air defense system to most Gulf countries. And imagine, these countries that spend, I don't know how much, a lot of money on the defense system, trying to fight all the drones and ballistic missiles, will have to replenish their inventories. They will have to buy more from these companies. What will happen to the stock prices of these companies? As sales increase, revenue increase, and these companies will tend to benefit. At the same time, investors often rotate towards defensive sectors, such as utilities, healthcare, and consumer staples, depending on the macro backdrop, of course. Now, when we talk utilities, utilities tend to perform relatively well because demand for electricity, water, gas remains stable even during crises. Right? I don't consume less water if there is a war, or most of us, right? So in the local markets, in the UAE, we talk about here something to consider would be Diwa and Etisalat, for example. When we talk consumer staples, this is another sector that is considered defensive and could be affected less from what is going on. Consumer staple companies sell essential goods that people continue to buy even during economic and geopolitical stress. Here we are talking about Procter & Gamble, Coca-Cola, Nestle, Walmart, Unilever, for example. And guys, because markets are forward-looking, investors should think beyond the current events. Post-war reconstruction often creates major opportunities for construction, engineering, and infrastructure developers. And the best example here that a company that has benefited a lot during past geopolitical events and after wars is Halliburton. which is a logistics and infrastructure responsible for logistics and infrastructures in conflict zones. Now, the sectors that, on the weaker side, the sectors that takes the biggest blow are travel and leisure. These sectors can be pressured by fuel and route disruptions. These sectors are very sensitive to security concerns, fuel costs, and travel restrictions. So what could happen to airline companies that are not flying due to the current situation? To the hotels, for example. Cruises. Cyclicals are also sensitive to growth and input costs. So cyclicals can also suffer in growth if growth expectations weaken or costs rise. Here we talk, for example, SALIC. Economic uncertainty slows investment in large purchases. Higher energy and input costs reduce margins. And if geopolitical tensions could push inflation higher and bond yields up, some sectors may struggle, such as real estate companies. If the war takes more time, what will happen to real estate companies? Especially if interest rates go up. If inflation goes up, interest rates go up, what happened to mortgages? They will cost more. People will not be incentivized to go and buy real estate and pay high interest rates on their mortgages. So real estate companies could take a hit. Now, no matter what happens, it is important to remember that markets always recover. And here are concrete historical reference points. After the September 11 attacks, the first week of trading saw the S&P 500 fall more than 14%, but it recovered after. During the 1990 Gulf crisis, the S&P 500 sagged roughly 15% between August 1990 and January 1991 as oil spiked. But then what happened? It then rallied as the war began and crude fell sharply. After Operation Desert Shield in August 1990, the S&P 500 recovered its initial losses and within few months ended 1991 up over 29% from that August 1990 launch point. Now, if we go back to the 2003 Iraq War, the S&P 500 recovery began even before March 20, 2003 invasion and ended the year up roughly 29%. We have also the Russian versus Ukraine war. Market took a hit, but it recovered. Look, this is the S&P 500. Russian-Ukraine war started in 2022. Now look the market. It's almost 50% above these levels. So yeah, the key takeaway is that markets always recover, guys. Gold often acts as a hedge, but it can temporarily fall when liquidity is scarce. Oil is the main transmission channel from geopolitics and into inflation and monetary policy expectations. And equity performance depends on whether the shock stays contained or become a sustained inflation and growth problem. I really hope you enjoyed this webinar and I was able to shed the light on important facts that you can use in your investment and trading journey. Before we end this webinar, I want to talk a bit about Daman Markets and present to you our amazing Ramadan offer. Daman Markets is a UAE-based broker delivering professional and premium access to Forex, commodities, stock indices, and local stocks, as well as crypto in the region. We are licensed by the Securities and Commodity authority of the UAE, category 1 license. And this is very important for you as our clients and traders, because this is what basically this is very important. So whenever you are choosing a broker, the regulator is very important. And we are licensed by the strongest regulator in the region. Now, we are backed by 2 decades of market experience, and we combine trusted infrastructure with modern tools to serve the region's fast-growing trading community. When you trade with demand markets, basically, you are trading with a broker that is providing you with tier 1 liquidity, professional trading tools, dedicated support around the clock. You will have a dedicated relationship manager or account manager, which you can contact at any time. The Demand Markets follows an STP model, straight through processing. So we just take your order and pass it through the market, pass it through the market, and we offer you 2 account types, classic and a pro account type. And now, during the month of Ramadan, we are having our Ramadan offer where you can enjoy 40% lower trading costs on AED accounts. So if you are in the UAE, you can trade using an AED account in the Emirati dirham, and you will benefit from 40% discount on trading costs. You can scan this QR code to try our demo account or to open a real account if you want. If you have any questions, I am Habib Akiki, and this is my email and this is my phone number. So you can reach out to me whether by email or by phone. And I'm looking forward to having you guys in our upcoming webinars. To know more about the webinar schedule, you can follow us on Instagram and join our Telegram channel to stay ahead of all the market happenings, the news, and our upcoming events. All you have to do is follow our Instagram page and join our Telegram channel. And I hope you enjoyed this webinar, and looking forward to see you again very soon. Thank you very much.